Volatility shocks the markets, but what does it mean for stocks? I'm your host, Steven Van Metre, and thanks for joining me today as volatility is surging higher and sending stocks lower, leaving investors wondering what the heck is going on. And in today's show, I want to share with you the underlying structures of the market and how it's affecting volatility and stocks. And this isn't something that most people know or even need to understand. And you may have noticed that I put out a lot of short videos over the last couple of days as volatility's gone up. Because when things like this happen out of nowhere and stock prices go down, people start to ask questions. And I wanted to point out that perhaps it had nothing to do with the economic data. There really wasn't anything unusual, and there wasn't really anything in the news flow geopolitically that's going on. But all of a sudden, it seems as if the underlying structure of the market has completely changed. Now, investors are buying the dip, but the question is, are they doing it in the right fashion? Are they going to find themselves on the wrong side of the trade again? Because it seems, as I'm trying to share with you, that the mechanics, the underlying structure, the market has changed. So what I want to do with today's show is take you through what's really going on through my eyes and see what you think. And we're going to do a little bit of a deep dive, but hang with me because we're going to start out with the Fed and we're going to end with the Fed. And I think when you understand what's really going on, well, I think you'll be surprised. Let's take a look. Let's start out here with the monetary base. This is effectively the Fed's balance sheet. And so you can see here when quantitative easing 1 happened, of course, the Fed's balance sheet went up. Here we have quantitative easing 2. Here's 3. And this we'll assume is maybe 4, 5, and 6. I'm not sure how many we're counting in this range here. But you'll notice that I've got the VIX or volatility index in red. And you'll see that when QE1 happened, volatility was spiked. And of course, we were deep in a recession, the great financial crisis. QE was new. And so the market reacted accordingly. But notice that here at the end of QE1, volatility spikes again as the Fed backs off. And then QE2, there's a little bit of a spike, but as the Fed comes out of QE2 and stops it, volatility spikes again. Well, then we have QE3. The market finally starts to understand this, and you'll notice it's not until they start to really taper here that volatility comes back again. And as they do quantitative tightening, volatility starts to pop up again. And then you'll notice when, of course, the pandemic hit, that caught really everyone off guard and sent volatility straight up. So the question then is, well, what's gone on since then? Because volatility actually hasn't gone up well at all, and the Fed's tapering. And that's kind of unusual because we saw at the end of QE1 and 2, the volatility spiked. And then we saw with QE3's taper, it did the same, but it hasn't happened. In fact, let me show you here. You can see that really volatility has been subdued. So let's zoom in to the VIX. Well, you go to my trading chart. This is a screen capture from it. And here we can see the pandemic volatility spike. And then you'll notice that generally every time the VIX gets between 30 and say 36, I know sometimes it's gotten a little higher, that all of a sudden volatility gets slammed back down. And there's some reasons behind this as vol sellers are coming in and slamming volatility down. Now, if you're not familiar with the term, now if you're a trader, you know what I'm referring to. But if you don't, what happens is there are people that are short volatility, and they can do that by directly shorting it. And so when volatility goes down, they actually can profit on those positions. Now, you might not know how to do that, and I strongly suggest that you don't. It's a very high risk thing to do. But another way you can short volatility is buying stocks or buying the major equity indices. Well, let's go back to the chart, and we can see that ever since the pandemic spike, that all of a sudden there's just been what we'll say vol slams. Every time vol gets up, it gets slammed down, slammed down, slammed down, anywhere it gets up here. And you'll notice I circled this point here, which is right the first week of December. Because what is contributing to the suppression of volatility? Well, you have to think about its retail investors and where were they getting money from? Well, the government was obviously sending people checks, one-time stimulus checks or child tax credits or extended unemployment benefits. People were getting money from the government. And when did that end? Well, it ended December 15th. And so we can see this is the last spike before the last check. The check comes in, volatility gets slammed down, and now it's back up here in this danger zone. And there's a real problem because if volatility gets out of the jar, if it comes out of here, well, check this out, because I tweeted this the other day. It says, if vol sellers can't get this market under control, there's going to be a lot of mechanical deleveraging into an illiquid market. Now, I have a lot of experience from the retail financial planning space, so I understand quite well how many retail products work and how they're constructed, because over the years since I've been in the business, the products started to change as companies sought to control risk, not only from their guarantees or benefits they were offering, but just from customer satisfaction. People don't like losing a lot of money, so companies started structuring products that could control risk. And this is pretty interesting because you see all of a sudden volatility spiking, and perhaps there's something else that could be going on here. And just before I put this show together today, well, Zero Hedge had this really interesting headline, an article that supported my tweet. It said how yesterday's miraculous market rebound prevented a massive crash. And let's go in here and look. It says, as we noted earlier, the bank's quantitative and derivative strategies desk estimates that systematic macro strategies, vol target funds, risk parity funds, and trend following CTAs, or you can translate many of those products that are actually designed to suppress volatility. As I mentioned, some of those are more retail products, but CTAs aren't. But I want you to understand what's going on here. So let's continue on. As of this moment, have equity supply of 15 to 20 billion over the next week, or about 3 to 4 billion a day, which is hardly catastrophic. According to Goldman, this is less than the daily buyback bid of about 5 billion a day. But had the S&P closed on its Monday lows down 4%, QDS estimates the group would have had at least 90 billion of equity supply over the coming week. And just so we're clear, they're talking about selling. So let's go to the next piece of this article. It says, or more than 4 times the current supply, and enough to crush the current extremely illiquid market, where the top of book liquidity is now down to 5 million, meaning it takes just 5 million of E-mini orders to move the ES1 tick. So what they're suggesting here is that if all these sell orders started flooding in, the market would crash. Now, this is interesting because they put a little bit of a chart here, and we're not going to go over it hardly in any detail, but I just want to point out that you see these risk parity strategies, vol targeting strategies, levered ETFs, and then, of course, you see some gammas having to do with options contracts and CTAs. And all of these things mechanically, one way or another, will start to sell when prices go down or volatility goes up, depending on their trigger. Now, the numbers that this article suggested are actually fairly small, because if you've ever read any research by Chris Cole, well, what you'll know is there's actually trillions of dollars in this that isn't even factored here. And you just have to look out at the insurance industry, who's a big seller of vol targeting strategies and various types of annuity products. And if these strategies start selling, and again, they're mechanical, they're all formula based. There's nobody sitting there that makes a decision. They just sell when they hit their trigger points. Well, that trigger point starts to happen when the VIX gets over 36. And when they start to sell, well, all of a sudden the wheels come off the market because there's no liquidity here to stop it. And that's what makes this really interesting, because it's a mechanical structure of the market that's causing problems here. Now, a lot of people don't understand why I refer to myself as bond king, because bonds are actually just a long vol strategy. See, when you understand how the mechanics of the market work, and that there's perhaps trillions of dollars that are going to sell in these strategies, well, where do they go? Well, it just so happens the first destination for many of them is the bond market. And if things get really extreme, it's the money markets. Well, the problem with money markets is it's effectively backed by the Fed, which is normally should be backed by T-bills. But in a sense, all this money flows into the bond market. Now, when you understand all of these relationships, then the next chart is hopefully going to make perfect sense to you, because what we should see in this next chart is that when volatility spikes and all these machines and all these algorithms start mechanically shifting, guess what should go up? Bond prices. Or in this case, I'm going to invert interest rates because the Fed chart won't do it, so you can see it. Check this out. So here, let's go back to the great financial crisis. We see in red volatility going up. And again, what we should see is volatility rising and then interest rates falling. Now, I've got market yield on 10-year treasuries shown inverted, so it would more look like bond prices going up. But nevertheless, what do we see? VIX goes up, mechanical selling of vol strategies that are forced to delever, interest rates go down, again showing inverted. And look here, around somewhere in 2010, vol spike, interest rates collapse. Makes perfect sense when you understand how these products work. Look at 2011, vol spike, interest rates go down. Remember, shown inverted. You see it here, a little vol spike, interest rates go down. Even after this part right here, you get a vol spike. You don't get a big move here because it got under control fast enough. But then you see, look at 2019, volatility spikes a bit and just kicks off just enough to get algorithms to shift into other programs. So there's also momentum strategies that look at trends and they follow them. So what you see kind of there around 2019 is these strategies started to delever a bit and they kicked other strategies into buying bonds and send interest rates down. Again, remember this chart shown inverted. And then what do we have here in the pandemic? Vol spike, and then all of a sudden interest rates all crashed much lower. And again, it's all designed on the system. So when people tell me, Steve, there's no way interest rates can ever go down again. Well, you don't understand that the bond market is effectively a long vol strategy, and there's trillions of dollars that could delever into an illiquid market that could feasibly drive volatility to levels never seen in history. Of course, that would also take the yield curve practically to zero on the long end, which I'd be okay with. But I want you to understand that what's going on here is that investors are buying these dips thinking that we're not in a bear market. That's kind of why I did a video on that today, because it says we are in a bear market. But when you see the mechanics of the system underneath and how it functions, you realize just how dangerous this thing can get. And from a portfolio perspective, for a lot of investors, it can be really dangerous unless they're sitting in a strategy like Portfolio Shield, which is designed to hedge and control these downside risks in the market. If you haven't checked it out, perhaps you should, because when you understand what's going on here, then you understand what's really going on, and the market has nothing to do with the news, may perhaps have nothing to do with the Fed, because what are we going to hear from the Fed tomorrow? Well, we're going to expect them to, in their quantitative easing program, about finish the taper in March. Well, the next reset that the Fed can lower is mid-February. They've already put their schedule out, so we'll assume that perhaps they will go from mid-February to mid-March and in the program, and then they will probably suggest tomorrow that there's going to be a rate hike in March. But if volatility gets out of control because there aren't enough investors to buy all these dips and keep the genie in the bottle, well, it's going to explode higher, and all of these mechanical algorithmic strategies are going to be forced to sell. And when you understand that, you understand how volatility could go straight through the roof and what's really going on in the markets. I'm Steve Van Metre. Thanks for watching. We'll see you soon. Bye now. The content of this video is provides educational information, is not intended to provide investor advice. It should not be construed as recommendation or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre in personal capacity. Please express this video that do not reflect the value of Financial Advice Inc. or Steven Van Metre Financial.